Welcome to Control Plus Q, where we discuss economics, finance, and investment from the perspective of high school students. Hello, everyone. In this episode, I spoke with Isaac about the basics of stocks and bonds, what they are, and how they behave in the market. How you doing? How you doing?
Good, good. Yeah, thanks for having me back, Ian. I really appreciate it.
Yeah, of course. Okay. So just to get started, we're just going to talk about kind of like the fundamentals of investment, like stock, bonds, and like mutual funds and things like that. And so just to like kind of start off, can you like help us get an understanding of like basic concepts of investment? Like, for example, stocks, like what are stocks and like how do they work? And just like kind of how do prices influence those stocks?
Yeah, great question. So, stock really is reading the actual technical definition of it's a represents a piece of ownership of a business, right? So,
Right.
and it's in a public form, meaning that you can buy when we refer to stock as opposed to shares. I mean, it's kind of the same thing, but you can buy a business that's not publicly traded. Publicly traded would be, I'm going to buy Apple shares, shares of Apple. That's actually one of the first shares I ever bought when I could buy shares. But you don't have to buy a publicly traded company. You can actually, if you have money, you could actually make an investment in a private company. So it is kind of called shares of stock as well, but essentially we're more prone to understand that shares of stock is more affiliated with publicly traded companies. But at the end of the day, really what it is, it's a share of ownership. So if you have 100 shares that make up a company and you own one share of that company, then you own basically 1% of that company, which means any generally pass through of profits would be, you would share in the revenue or excuse me, share in the profits. And let's say the company earned $100,000 in net profit. Well, then you're entitled to 1% of that, would be, of course, $1,000, right? So really, yeah, stock is a share of ownership. So the trade-off is basically you're limited, or let's maybe refer to it more for like a pros and cons standpoint. The pro is you have unlimited upside. Okay.
Right.
I would also say the pro is you have limited downside because technically you're only limited to the amount of your investment. So
Mhm.
if you put in 1,000, that's the most you can lose. So, and then you also have the unlimited upside. Another nice pro, I would say, is dividends. So if a company pays out a share of their profits, not to get too technical, but basically dividends dividends will come from retained earnings, which is basically accumulation of profits over a period of time. And a dividend could be paid as well as a shareholder. So
Mhm.
um, the negative, the con. So if there's a bankruptcy, you are the last in line if there's any residual assets left to be divided to the shareholders. Okay. So anyone who starts a business and let's say borrows money in the form of a loan, okay, those creditors are paid before a shareholder. So essentially, if there was anything left after you pay off your debt, the remaining goes to the shareholders. So if you own shares and the company goes bankrupt and they run out of money, then you are entitled to nothing. So,
Yeah.
uh, so you are the last to get paid. So that's basically the biggest con. I would say the negative to probably a shareholder. Yeah.
Yeah. Also just to like clarify, what's the difference between like a share and a stock? Because I think you mentioned that there was like basically the same thing, but like what's like the nitty-gritty difference?
Yeah, the stock is really essentially the representation of the company, like from a label standpoint. Kind
Mhm.
of like a road sign, right? A road sign is like, hey, this is a sign that says don't turn here or do not enter, right? If you
Mhm.
cut that road sign up into little slices, that would be shares of that stock.
Oh, okay. I see.
Yeah, so
Just
shares are just like bits and pieces of
oh, I see.
the entire company, entire stock.
Okay. And then what powers other than like just having the stock do you get if you have some sort of ownership? Because if you have an ownership, are there like different levels to it? Is it do you have different powers based on what type of stock you own?
Yeah, actually, that's a great question. There are different types of share classes. Not to get too into the weeds, but there are, different forms of share classes through voting rights, essentially, at the end of the day.
Right.
So if you have a special share class, I think Google, if we look at that one, which is there's GOOG and then GOOGL, which is the ticker symbol. So there's two different share classes. One has voting, I believe. And don't quote me to this or don't hold me to it because um, I haven't looked at this in a long time. But I believe one has a voting class and the other does not, I believe. So then you also have preferred shares, which is kind of a mix between a bond and a stock, which I can talk about that in a second. But you are right. There are various different forms of shares. Most people, and what's most common is essentially what we call is actually no pun intended, but it's called common shares. It's
Hmm.
essentially what we are most familiar with. So common shares just represent one share, and each share will be priced according to what the market feels it should be priced at. So, uh,
Right.
so essentially, a common share is, one common share generally is entitled to one vote. So,
Hmm.
when would we like? It's like what are we voting for? I should say. So, voting could be like a new board of directors or a new board member, CEO, CFO, kind of the C suite. Day-to-day operations is not really necessarily included in that. But like a takeover, like buying out a company, acquisition, so forth, those are things that could be part of the mix if presented to the shareholders. But generally, if you have a share that's entitled to be voted, you are also allowed. And I think this is actually entitled to all what we call stakeholders, but you're allowed to go to the annual meetings as well. So by law, every publicly traded company has to have an annual meeting. It's part of informing your investors of what you're doing, and it's good prudence, good uh, fiduciary type exercises you can do for your investors.
Yeah, and just kind of going back to what you were saying before about bonds, I know you said you would touch more about it. Just like what are bonds? Like how do they differ from stocks, and how do like bond prices fluctuate as well?
Yeah, so if we can imagine, let's say, let's use it like more like in relation to like a mom and a dad. So let's say the dad is shares, okay, or like equity or ownership, okay. So if you think about that, equity and ownership, you have unlimited upside, as I mentioned before.
Mhm.
Limited downside is just the amount of your investment. Yet, you do have voting capabilities, which is actually a plus again. But the con is like you're last on the list to receive any kind of dissolution, residual assets in case of a bankruptcy. So that's the equity side. The mom is, let's say, the bond side, and doesn't matter who's who, of course, but the mom would be the bond side. And what's the bonds represent? Well, instead of equity, where you own a piece of the business, now you're a essentially on the creditor side, I should say,
Mhm.
where you don't own the piece of the business. So if you buy a bond, that really at the end of the day, at its core, is like you just actually loaned them some money. Okay.
Right.
So, like the government, the US government, we're very familiar with treasury bonds.
Hmm.
And why, like, what do we do with these? These are the most safest assets technically in the world because they're backed by the US government. So, when we buy a bond from the US government, we're essentially loaning them money to say, hey, US government, go ahead and take some of my money, build some roads, build some bridges. In return, just pay me an interest payment. That's it.
Mhm.
So essentially, we almost like become the bank. Instead of
Oh,
going to the bank and borrowing money, to buy a car, a house, computer, whatever else, like a credit card, we become the bank. We become the credit card, and we get paid interest in return. And obviously, we would like our money back, our principal. So
Right.
so anyway, so the two they're very similar in how we invest, except equity you have a lot more upside. I mean, it's technically quote unlimited, but the bond you're only limited to the interest rate.
Oh, I
That's
see. So it's more like a fixed rate of like you know how much you're gonna get back.
exactly,
I
exactly.
see. And then when would a company choose to give out bonds or give out stocks? Like, is there other different stages of a company where they say like, oh, I'm gonna try to give out a lot more bonds or like try to open up some stock options?
There is, yeah, and this is a little bit um when you're growing a business, I would say it's there's no kind of like hard set manual. I mean, you can look
Right.
at your competition and so forth, but as far as when is it appropriate to do debt offerings, when is it appropriate to do like share of issuances, like equity offerings? Well, equity offerings is going to be like, okay, the trade-off is you're going to give away some of your business.
Hmm.
So if you're an owner and you start a company and it's doing awesome, it's doing amazing, you may not want to like just give up some of your business. So we
Right.
can always think about that show Shark Tank. You know,
Yeah.
you've watched that,
Yeah.
right?
Yeah.
Great show. You know, we always watch that and we're like, well, you're giving up, 20, 30, 40, sometimes 50% of your business. And that means if you give up that much, that means you're giving up that much in profits, right? So like if you
Mhm.
start growing real fast and your profit is growing, of course, kind of in correlation to the growth. Well, deep down, you're like, man, I'm giving away 25% of my profits to this investor or these investors, which you could be holding on to 100%, you know?
Yeah.
So it's kind of comes down to like, what does the ownership of the company feel like doing? If they think it's more appropriate to, offer share issuances, let's just put it simply, if you want to offer some equity into your business where all your investors can participate in the upside of your business, um, then that's going to be, you're probably going to have a lot more people, probably a lot more investors who would be interested in that. But if you're like, hey, I don't want to give up any ownership, but I still need to raise money,
Hmm.
well, you could just do it through debt, which means you can just say, hey, I'm looking for a, $500,000 loan, and I'm willing to pay a higher rate of interest because that's the trade-off. It's like, listen, you're not going to be an owner or you're going to get unlimited upside. But how about this? You can be, why don't we do in the form of a loan and I'll pay you a higher interest rate. And basically, I'll pay you the principal at the end if it's kind of a lump sum payment at the end, or in stages, you're paying interest and principal along the way, kind of like a normal loan. So all that to say is like at the end of that term, the owner still has 100%.
Oh, I see.
Yeah. And the owner, though, is on the hook to pay the creditor back if something bad happens. Whereas if you raise money from shareholders, if something bad happens, well, that's it. There's
Right.
no harm, well, I wouldn't say no harm, no foul, but basically your investors lose all their money, but they don't lose more than what they put in. And they understood that.
Okay, I see. That is all for this episode. Thank you for listening, and I will see you next time.